Good morning. Welcome to Stock Market Today. It is Thursday, September 17th, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas to consider. Hit your inbox every trading day before the market opens. U.S. equities were mixed yesterday after the FOMC meeting highlighted that rates were likely to stay at these low levels through 2023. So you can't convince me that the Fed sees a V-shaped economic recovery when we're going to take rates and keep them close to zero for the next 3+ years. Treasuries were narrowly mixed with the curve steepening. The dollar was under pressure against both the yen and sterling, but better against the euro. Gold was up 20 basis points. WTI crude higher by nearly 5% after bigger than expected draw was reported. In addition to that, we have a hurricane making its way through the Gulf, leading to some production stoppages. And as we get to the desk this morning, futures are down about 1% after Asian markets were weaker overnight. Hong Kong, Australia, and South Korea, the big decliners. European markets are weaker. Treasuries are mixed. Dollar firmer against the euro and sterling, but lagging the yen. Gold is down 1.2%. WTI crude is off 60 basis points after rallying nearly 5% yesterday. So as we dive into the structure of things, well, the S&P 500 could not make it two in a row above the 3,400 mark as we closed back below yesterday. 33.85 close and then down 1% today. To me, that signals rising odds of a test of 3250. Nothing guaranteed in this market, but my view is below 3,400, your odds are higher of 3,250. Above 3,400, your odds are higher of 35 to 3,600. Pretty simple, really. What I do see is a lot of opportunity to get chopped up as we oscillate around this 3,400 mark. So remember, folks, there's no rule that says you have to trade. If your setup is not there, if the market's choppy, if you feel like your setups aren't working, don't trade. You don't have to trade. So far, the Qs are holding 270, and that's being tested in the pre-market. I think a break of that level would lead to a cascade to the downside. Same with a break of 150 for the IWM. IWM looks okay for now, but small is certainly not leadership, at least not from a trend perspective. We'd like to see that change, but it hasn't changed just yet. So to me, I'm watching, I'm waiting. I want to see the close above 3,400 because there were some good setups in tech names, especially, at least by my work, but they're not working. So we wait, and now we're back below 3,400. That's at least my view. You have to know you have to know your time frame, you have to know your risk profile. Let's talk about our market in a minute. What are we writing about in the note today? Well, SPY fails to hold that 3,400 level, 340 for SPY. And remember that Chaikin bullish percent? That continues to hold below 30%. Remember that chart we talked about last week, and we said when it crosses below 30% from above, likelihood of volatility increases. Remember we talked about that last week? Still in play. Don't forget it. What I say one day doesn't get disregarded the next. This stuff all starts to build on each other, and it's important for you to remember it. Take notes. Breadth metrics improve, but that divergence remains in play. The Fed to keep rates near zero through 2023. That's, to me, says a lot. And, futures are telling you right here, they want lower. I think what the futures are telling you is that the Fed can only do so much, and the fiscal side of the house needs to get their act together. That's what I think the futures are telling you. That we have to see some sort of fiscal response. Get it together. Let's look at the Dow here. 5-3 bulls to bears, adding 16 basis points yesterday. S&P 500 down 38 basis points, 126 to 64 bulls to bears there. S&P, NASDAQ down 1.6%, 21 to 9. So we're seeing deterioration in the power bar. Small caps outperformed. Bonds down ticked. Energy was your big leader yesterday. Up 4%, 7 bulls to 7 bears in the energy complex. XLE. Remember what I said about XLE? I mean, I'd love to see it get better. I really would. I would love to see it get better. It's just not there yet. And until it's there, neither will we be. Take a look at our stocks of the day now, sticking with this theme. Now, Tuesdays and Thursdays providing you with a screen. This week's screen is kind of interesting, or this screen for today is kind of interesting. What I did was I looked at the Russell 3000, didn't care about the rating. Any rating is fair game. Bullish, bearish, neutral, everything in between. And I just wanted stocks whose relative strength, remember our relative strength metric that I show you on all of our charts, whose relative strength turned weak this week. Right? These are stocks that are, as the market chops, as Qs try to hold 270, as IWM tries to hold 150, as the SPY tries to hold 340, these are the stocks that are losing relative strength, starting to become weak on a relative basis. Some high profile names in there: Google, NASDAQ, Humana, right? Dexcom was a big leader, Teleflex. Okay, do the work. Take a look at these names. If you own them, you have to ask yourself, why do I own these stocks that are beginning to underperform? You're looking for bearish opportunities. Maybe you take a look at a few of these and see if the setup is there into emerging relative weakness. So I think at the very least, you have to question why you own these stocks at this point. You have to maybe consider them as source of funds to raise some capital, especially if the Qs start to break 270 and we get a cascade effect to the downside. This is very contingent, right? The odds change every day. SPY above 340, Qs above 270, IWM above 150 is a better setup. Now we're watching. I think there's chop. You certainly do not want to own the underperformers. Let's look at the sector tracker now, moving to the major sectors. Last 5 days, REITs top of the list. So you have this defensive yield group at the top of the list, information there. Industrials and materials, our two favorite cyclical groups. You can keep the financials and energy all to yourself. I have no interest there at all whatsoever. I'd love for that to change. I'd love to see evidence that it should change. I just don't see it. I highlight the banks in my note today, KBE. Just don't see a reason to get involved. Middle of the road, utilities, energy, and healthcare. Laggards are your kind of growth areas of the market. Discretionary comms, tech. Throw staples in the mix as well. So it very much is a mixed bag. There's no clear picture here, and I think that that's really frustrating. There's a lot of cross currents. S&P dancing with 340, but you don't have staples outperforming, right, which is a traditionally defensive group, while Utes and REITs are picking up. It's just a lot of cross currents there. If there was ever a time to not be trading, I think this is it. I really do. I think if you have your positions and they're above your risk management threshold, great. I think that if you've taken some exits because you've gotten stopped out of names, great. Now you have cash to put to work when things look a little more clear. That's a pretty simple concept. That's actually what I've done. I've taken a lot of exits, taken cash off the table, and now I'm waiting for some clarity. At least that's what I've done in my personal account where I trade equities. Our industry and folks today, pharma services, past 6 months, underperformed by about 3.5%. 12 to 8 bears to bulls on the power bar ratio, earns at a rank of number 18 of 21 subsectors, down 4 slots. Names we want to avoid: Axum Therapeutics, Zogenix, and Reata Pharmaceuticals, AXSM, ZGNX, and RETA, respectively, as they are holdings in a fund that looks... this is a mixed bag, right? With a bearish bias, obviously, because of the rating, the ratio, but we have a sideways trend at best. It's an underperformer, but relative strength is getting better. It's overpriced. This kind of speaks to me about the entire market. I can argue a bull case. I can argue a bear case. There are enough cross currents to make your head spin. Why? I don't want to be involved. Certainly don't want to be involved in these pharma names, especially don't want to be involved in an area that could be bifurcating heading into the election. Let's look at yesterday's movers and shakers, gainers and losers. Oxy, some news of Western Midstream deal sent that stock higher by 8.7%. Diamondback, solid on the back of energy strength. Same with FTI. Both of those stocks up over 7%. TPR caught an upgrade at Deutsche Bank, 7.5% to the good. OKE was mentioned positively in a survey out of Citigroup. That stock higher by 6.7%. Illumina is going to rebuy a cancer testing company pre-IPO. And that's the news headline I saw there. And I'm not deep enough in the weeds on the story to understand why it's down 8.4%, but it is. BWA, no news there, down 6.4%. NEE, exposure to the storm that's raging through the Gulf of Mexico. That stock lower by 4%. Earnings and guidance send Adobe down 4.5%, and Las Vegas Sands caught a downgrade at Roth Capital, down 4.2% yesterday. Let's dive into the charts now. Breadth metrics improve, but those divergences, percentage of stocks above their 200-day moving average rebound to 65%. So healthy majority, right? Again, remember what I said about all the cross currents? I can make a bull case, I can make a bear case. I can make a bull case, I can make a bear case. In the meanwhile, SPY is dancing with 340. Maybe it's all just rotation, and that's what's leading to the choppiness. I don't know the answer. We can see the rotation into some of the cyclical areas, right? The ones I've talked about, materials, industrials, the ones everybody else seems to be waking up to now. So we can argue it both directions. The divergence bothers me, but you still have a healthy majority. So when you talk about breadth, is breadth okay? Yes. Did it improve? Yes. Does that divergence still remain in place? Yes. Advanced decline line is kind of the only thing that's not diverging, holding above the February breakout level as the S&P 500 tries to get back above that 340 mark. So a mixed bag, you can see it however you want. I'm choosing to lay it out for you, right? The percentages of stocks above their 200-day, stocks above their 50-day, healthy majority, right? 65 and 66% respectively. That's a good number. But the divergence is something to be aware of. Advanced decline line, that's fine. So argue your case. What I say is manage risk. Manage risk, whatever that means for you. If that means having more cash so you feel comfortable, great. If that means setting your stop and taking your exits, great. Whatever it is, managing risk should be a priority. And with the chance of heightened volatility, it has to be a priority. Now, here's that Chaikin bullish percent. Remember last week I showed it to you and I said when we cross below 30, chance of volatility picks up, right? Over the next month, the market's actually lower 51% of the time by an average of about 1%. Remember last week? Remains in play. And just kind of, remains in play. So what does that mean for you? For me, I bought call options on the VIX. I have a bullish bias to my portfolio, but I see something like this. I bought call options on the VIX. Just there. Just in case this plays out. So that's how I kind of think about things, especially in this choppy market environment. But the volatility that we cited last week is playing out. We're going back and forth, big swings in the market here, especially in the NASDAQ, which is moving over 1% at a clip. Finally, is the market going to call the Fed's bet? And this is interesting to me because the Fed just told you rates are going to stay lower for longer, down at these levels. And here's the 10-year. Didn't crack. Just kind of bouncing along the bottom there. Right? We had a bullish divergence here at this most recent low. I highlight for you here. We're above the 50-day on the 10-year yield, but below a declining 200-day. So I'm wondering if the market's going to call the bet. I don't know how it's going to play out, but it's kind of interesting that yields did not move lower on that news yesterday. So it's interesting when the market doesn't react the way you think it should. I noticed. So let's pay attention to that going forward. That'll wrap us up. Take us for a test drive. I'm back tomorrow.